Assalamualaikum warahmatullahi wabarakatuh and good afternoon. This special slide is an extension to the online lesson on the topic of accounting for partnership, because when I created the online lesson, I was referring to Wegant and Kiso's book. However, those that have been discussed by the other sets includes a certain part which was not discussed in Wegant and Kiso. Therefore, I create this video as a supplement from the lesson that I have created before. But nevertheless, this is a very important part. This is a very important portion on the topic of accounting for partnership. Okay, so please go through this video and understand the differences that I will show you. Okay, so the main difference between this slide and the online lesson is that we will be discussing on the differences between the fixed and fluctuating capitals. Okay, in the online lesson that I have put up before, it does not discuss the difference between fixed and fluctuating capitals. The examples that I shown all are related to the fluctuating capitals method. Okay, but the fixed capital method is also as important. Okay, so what do you mean by the fixed and fluctuating capitals? Okay, so in all of the types of organizations, an important component is the capital or the investment that the owners have put into the business. Okay, so for partnerships, the different partners will have their own capital accounts. For sole proprietorship, there's only one capital account because there's only one owner. But for partnerships, there will be several capital accounts based on the number of the partners in the business. Okay, so what we have discussed before is the fluctuating capital method, where the capital account will change frequently. Okay, basically every year the capital balance will change under the fluctuating capital method. Okay, but there's another way of managing the capital inside the partnership, which is the fixed capital method. In the fixed capital method, the capital remains constant until the end of the partnership. Okay, so what are the things that would usually change the capital account in the fluctuating capital method? It will be salary and commissions of partners. Okay, so in a year of operation, when there are salary or commission paid to the partner, then that will eventually add to the balance of the capital. Okay, the capital will increase. The capital of the partner will increase based on by the salary and commission that the partners received. Secondly is the interest on partner's capital or interest on the drawing of the partner. Okay, so when there's any interest, when the partnership agreement states that the partners will receive an interest based on the amount that they have in the business in terms of capital, then the partner will receive interest on that. Okay, so that interest will eventually change the capital account. Similarly, if the partners are charged with any interest on the drawings, then that interest will be deducted from the capital account. The capital will be reduced. Thirdly is the partner's share of profit. So after the operation of a business, after one period, accounting period, then we will of course we will calculate the profit, but then we will calculate how much profit will be distributed among the partners. So each partner will get a share of the profit. Under the fluctuating capital method, that share of profit will be added to the capital balance of the partner. Therefore, their capital will increase. And finally is the additional investment. So whenever the partner put in extra money into the business as additional capital, or he brings new assets into the capital, into the business as an investment. Therefore, that will add to the capital account, okay, under the fluctuating capital method. However, in the fixed capital method, these types of changes will not affect the capital. Okay, capital does not change due to salary or commission of partners, or interest on partners' capital, or interest on the partners' drawings, as well as the partners' share of profit. These things will not change the capital of the partner. Okay, the only thing that will change the capital of the partner will be the additional investment. So for example, if a partner starts off the partnership bringing in 100,000 ringgit into the business, so his capital will be 100,000 ringgit. But then if after several years he adds more capital, he adds another 50,000 ringgit, then that will increase his capital. But his capital will not be increased by the salary or the interest or the share of profit. Okay, so that's a main difference. However, the capital will change due to additional investment. And then under the fluctuating capital method, there is one account called the capital account, will be allocated for each partner. So if the business has 4 partners, then there will be 4 capital accounts as shown in the balance sheet. Okay. However, under the fixed capital method, each partner not only has one capital account, but they will also have the current account. So there are 2 accounts allocated for each partner. So if there are 4 partners, there will be 8 accounts, one capital account and one current account for each of the partner. Therefore, under the fluctuating capital method, all of these changes, all of the 4 types of changes, will be sent to capital account during the closing. Okay, but for additional investment, it will not be sent during the closing, but it will be credited into the capital account as at the time of investment. But for the other items, okay, salary, interest, and share of profit, those will be sent to the capital account at the closing date of the business or of the year. However, under the fixed capital method, all of the changes, all of these types of changes, the 3 changes, will be sent to the current account instead of the capital account. So that's why we call it the fixed capital method, because the capital account does not change. Does not change unless there's an additional investment. It does not change by salary, interest, or share of profit. The change will be reflected in the current account. Okay. The capital account will not change, but the current account will be changing every year based on the salary, interest, and share of profit. So those are the main differences. What I have discussed in the online lesson, the previous online lesson, is the left side, which is the fluctuating capital method. But I'm introducing today is the fixed capital method, which in practice will create 2 accounts, one capital account and the other is the current account, and only additional investment will be affecting capital account, whereas the other 3, the salary, interest, and share of profit, will affect the current account. Okay, let's see how the differences that we have mentioned above or before this will affect the entries into the accounts. Okay, so we will look at the main place is at the closing entry. For the fixed capital method, and other methods as well as different types of organizations, the first step of closing the accounts will be to close all revenue and expense accounts to the income summary account. So we will debit all of the revenue accounts and credit the income summary account, and we will also debit the income summary account the total amount of all the expense accounts, the balance of the expense accounts, and we will credit all of the expense accounts. The second step is to close the income summary into the current account of all the partners. Okay, so we will transfer all of the income summary into the current account of the partners, based on whether or not the income summary is showing net loss or net profit. So if the credit balance of the income summary account is more than its debit balance, then we will debit the income summary and credit the current accounts of the partners. If income summary has a debit balance, if debit is more than the credit side, then we will credit the income summary account and debit the current account of the partners. So that will be transferring the profit, or that will be the profit or the loss of the income, okay, or the profit, based on the portion that the partners will receive. The third step will be closing the drawing accounts of each of the partner into the current accounts. Okay, so transferring the drawings. So debit one partner's current account and credit its own drawings, and then we will debit the other partner's account and credit its drawings. So this is how we close the entries of the under the fixed capital method. And if you see here, this is the main difference between the fixed capital method and the method that I have shown you in the online lesson. The method I have shown you in the online lesson is that when we close the income summary, we will send it off to the capital account of the partners. Here, the difference is that we will close the income summary and send it off to the current account of the partners. Next, we will see the effect in the statement of financial position or the balance sheet. Okay, the effect will be seen in the owner's equity section of the balance sheet, and under the fixed capital method, there will be twice the amount of the accounts will be twice the amount of the partners. So if there are two partners, there will be 4 accounts, one capital account and one current account for each of the partners. So there will be 4 in this case. Okay, so you see here that the first will be the capital account of each of the partners. So these capital accounts will not change based on the share of profit or the interest on capital or drawing, as well as the salary of the partners. But those transactions will impact on the current account. So you will expect that the current account of the partners will be different, will be changing every year, but the capital account will be stagnant, will be remaining the same, unless the owner brings in additional investment. So that will be the main difference between the fixed capital method and the fluctuating capital method. Whenever you are asked to produce the capital and the current account of the partners, that means that the business is utilizing the fixed capital method. However, if it just asks you about the capital account, then usually it's using the fluctuating capital method.